Firstly, I propose to have a look at the chart of the US dollar index, because sometimes when we study the currency pairs we trade, we forget about the general dynamics of American currency, the general trends which exist in the US dollar. And I think having a look at the US dollar index helps to analyze American currency better and to make better forecasts for the currency pairs. Probably better to start looking with the weekly chart. You can see here that the overall uptrend in the US dollar index still exists. The week before last, there was a bullish engulfing pattern, and the price managed to reverse up from support line. Support line actually goes back to May of 2016, and US dollar managed to reverse to the upside to trade currently above 101 area. However, we can see that there is a kind of consolidation phase. We see that the US dollar is consolidating within a wedge, and that we are now getting close to resistance, which is located at 101.50. This is resistance line which is drawn through this year's high, and this would be the third point where this line will touch the current market price. So I think that the existence of this resistance line tells us that it might not be easy for the bulls to overcome this level. As for support levels, here we can say that support is located at the area of 100.50 lower, and the psychological level of 100.00 and around 99.20. So at the daily chart, maybe you can see that in greater detail. Here I have some moving averages, and currently the dollar index is testing 100-day moving average to the upside, and there is some scope to the upside, some further scope to the upside this week before they hit this resistance line, which goes from this year's high. And looking at this chart, it is reasonable to discuss the fundamental factors which are lying at the base of this movement of the American currency, for us to have a better understanding of what is happening with the US dollar. All in all, we can say that the economic news for the greenback, which were released during the last week, were more negative than positive. American manufacturing growth slowed to 6-month low. US non-farm payrolls failed to impress the market. America added only 98,000 of new jobs in March versus the forecast of 174,000. But here, to be fair, we need to point out that at the same time, American unemployment rate declined from 4.7% to 4.5%, and this is a fairly good reading for the unemployment rate. And average earnings showed a stable growth of 0.2%. In fact, we can see now that inflation is the most important indicator in terms of the Federal Reserve's monetary policy. Earlier, the Fed was targeting labor markets really strong, and its policy actions depended on the state of American labor market. It happened because there were real problems. There was a huge decline in the number of jobs during the financial crisis of 2008, and from that time, we saw constant problems with non-farm payrolls, with unemployment rate. This is why the Federal Reserve had to improve the situation, had to help the economy, had to help American companies hire, and that's why they kept such an loose monetary policy, which included non-standard measures in form of quantitative easing. Now we see that the labor market has managed to come into a rather good shape, and the Fed has begun its tightening cycle in the rate of 2015. Now this cycle is continuing, and the pace of the rate hikes depends more on inflation than on the labor market, which is already rather well. As a result, we can see that non-farm payrolls doesn't have the impact on the US currency anymore, at least if we compare the current impact with what was a couple of years ago. Then the markets were trying to judge whether the Fed will do additional easing measures. Now we have a kind of different situation, and the fact that there was no slowdown in the US average earnings indicator did really send a positive signal for the greenback. So after initial decline on Friday, American currency managed to show a strong weekly close. And we can the conclusion we can draw from this information is that for now, despite the fact that the figures may, the economic figures may not seem very bright, still they may be kind of enough for the Federal Reserve to continue with its plan of 2 or more rate hikes this year. Of course, it is very interesting how the Federal Reserve will comment on this recent developments, and we'll hear about that today as the Federal Reserve's chair Janet Yellen will speak on Monday. It will be late during the US trading session, so there is still time ahead of this. And also on Tuesday there will be comments from FOMC member Kashkari. He will also address the public. So this is the insight from the Federal Reserve we may or may not get this week. I hope that some comments on the recent labor market data and the recent inflation data in the US will follow. So also the news from America were not only from this side. There were many political news. For example, House of Representatives Speaker Paul Ryan said that tax reform would take longer to accomplish than healthcare reform that actually failed in March. And of course, this was a source of concerns for the US dollar. We can see on the daily chart that there was a spike on Wednesday. And the market failed to close at the top of this spike on Wednesday. This happened because traders are concerned. They think that any hurdles to the tax reform are negative for the US dollar, as these hurdles may delay the Fed's rate hike. And in addition, the FOMC minutes on Wednesday showed that the Fed is going to trim its $4.5 trillion balance sheet into the end of this year or even earlier. And this was also interpreted as implying less need for the Fed's rate increases and hurt the US dollar on Wednesday. Still, the fact that after this spike on the daily chart, we saw no big sell-off of the American currency. On the other hand, during the following 2 days, the greenback managed to go higher and to close above Wednesday's high. Surely means that traders are not really concerned, but they still think that the situation is okay enough for the Federal Reserve to probably raise rates as planned. Also, there were political headlines from the meeting between Donald Trump and Chinese President Xi Jinping. And these headlines were positive. This is helping the US dollar a lot, as it seems that Trump is no longer aimed at calling China currency manipulator with great force as he was doing earlier. And it means that Trump's efforts to devalue the greenback, to make the greenback lower versus the currencies of America's trading partners, won't be probably as intense as they used to be. Also, we will get a block of the US statistics this week on Friday. There will be CPI data and also retail sales figures. So will be important to analyze these things as well in order to judge the further policy of the Federal Reserve. As a result, going back to the trend with the US dollar, I think that currency still has some opportunities to consolidate within this current wage formation. And I believe that there are needs for further bullish drivers for American currency before it will be able to break this resistance to the upside. So for now, I think that this week may come below this resistance line, and that we may see more of consolidation.